Investing comes with risk, but that's the price you pay for the higher returns. For the most part, you can mitigate this by having a well-balanced, well-diversified portfolio, but there are still risks that investors should be aware of. In this video, we will take a look at the 4 major risks and how to deal with them. Hi there, I'm Michelle. Welcome to my channel, where we talk money and having more of it. In this video, we're going to take a look at the 4 major risks investors face. And as I said in the intro, most investment risks can be mitigated by diversification. But the following 4 risks require some more strategic portfolio decisions. So let's dive in. The first risk is economic risk. And this is a risk we are all aware of, having navigated through the last 12 months or so of a global pandemic. Economic risk can have both expected and unexpected shocks in the portfolio. And again, we have seen the extremes of this as a result of the pandemic, where we've moved from the depths at the beginning, where it felt like the world was shutting down, unemployment spiked, and recessionary fears abounded. And now, just over 12 months later, we have the world slowly starting to reopen, employment picking up, but the talk in the market is of market bubbles and inflationary fears. It feels like we have been on the scariest roller coaster ever. So how you navigate through this is very much a function of your stage in the investing journey. Younger investors can use this as an opportunity to invest in solid companies cheaply, and as index investors, you get more bang for your buck when the market is down. For older investors, a major downturn in the market could be a much bigger challenge. As such, it's important to protect your portfolio before these events occur. So increase your emergency fund as you get close to retirement, and potentially also have a larger allocation of your portfolio in those kind of lower risk assets, such as solid fixed income securities. The second risk follows on from economic risk, and it's market value risk. And this risk generally happens when investors exit sectors of the market or the entire market in search of safer investing options. As we saw at the beginning of the pandemic, this panic usually taints the entire sector or market, and it doesn't discriminate between good and bad stocks, as participants just basically elect to exit and to put their investments into cash or some perceived safe havens, such as the government bonds of developed, highly rated countries. So market value decrease is a good opportunity for investors to pick up quality stocks which may have got caught in the downdraft of all the stocks, and so they can pick them up cheaply. But again, the risk of a market value event detrimentally impacting your entire portfolio can be mitigated by diversification and not having your investments focused into one asset class, one geography, or one industry. Inflation risk is the third of the major risks. Inflation reduces the value of our money, and the current consensus view is that the excessive stimulation provided by the government support as a result of the pandemic will bring inflation. Real estate, gold, and in some cases other precious metals as well have been considered inflation havens. And in more recent times, cryptocurrencies, and especially Bitcoin, seems to be fulfilling this function as well. Companies may initially struggle with higher inflation as they face higher input costs, and they may not immediately be able to pass this on to their customers through price increases. And this may then impact their share prices in the short to medium term. However, in the medium to long term, they're able to adjust these prices, and they too will benefit from the high inflation. Individuals on fixed income or reliant on returns from bonds will be hardest hit by the inflationary impact, as the returns they're getting will be worth less. So it is worthwhile to hedge against this by including some of the more inflation resilient assets in your portfolio, as well as inflation-linked government bonds to smooth the fixed income impact. The last of the major risk is behavioral risk. Now, as investors, we operate with a number of behavioral biases. that can pop up at the most inappropriate times and cloud our judgment and impact our decision making. Now, one of the most significant ones is our loss aversion, and this impacts our tendency to overstate our conservatism. And while being conservative and cautious when it comes to investing isn't a bad thing at all, too much conservatism can detrimentally impact our investment returns and mean that we cannot reach our investment goals. So it's really important to balance this conservatism, and that requires us taking analysis on where we are in terms of our investing journey and our personal capacity for risk. But the importance of getting sufficient investment returns cannot be overstated. On that note, if you're ready to face some market challenges, it's important to check your financial resilience. Take the financial intelligence quiz in the notes below to assess how ready you are. Thanks for watching this video the whole way through. If you liked the video, please let me know by liking it and share it with any other ladies who want to change their financial story. Put any comments below if you found anything helpful. For financial education and money talk designed for women, please subscribe to my channel. Speak to you soon.